Hello, my name is Brad Stewart and I am a member of Savant's investment research team. I am here today to provide a review of the markets for the third quarter of 2016. The second quarter showed positive returns across all regions and for almost all major asset classes except for commodities and managed futures. U.S. and international stocks were pleasantly positive while emerging markets delivered a stellar return of 9%. On the bond side, both U.S. and foreign bonds were just slightly positive during the third quarter. Alternative asset classes struggled during the third quarter. Global real estate remained flat, while commodities and managed futures both posted negative returns. The U.S. unemployment rate inched up slightly in September and ended the quarter at 5%. The slight increase is due to more workers entering the workforce and the labor force participation rate increasing. Inflation stayed flat at 1.1% year over year, a move in the right direction towards the Fed's target of 2%. The third and final estimate of second quarter real GDP growth came in at 1.4%. This represents a 0.6 increase from the final estimate of first quarter real GDP growth of 0.8%. There was a slight shift away from safe assets during the third quarter, causing an increase in the 10-year U.S. Treasury yield. We will show the effects this had on bond returns later in this presentation. Despite an early market decline in July, stocks continued to gradually rise for the remainder of the quarter. Although they lack explanatory power, there were some historic events and headlines along the way. Following Britain's surprise vote to exit the European Union, Theresa May took office in Britain following the resignation of the former Prime Minister David Cameron. The passing of another 4 years brought us to the 2016 Summer Olympics in Rio, Brazil. Team USA blew away the competition and brought home 121 medals. You can see near the end of the third quarter brief periods of volatility. During that time period, the U.S. Federal Open Markets Committee announced its decision to leave the target federal funds rate unchanged at 0.25 to 0.5%. Stock markets persevered and ended the quarter on a high note. The S&P 500 continued to gradually rise throughout the quarter and returned just under 4%. U.S. large value stocks were slightly behind with a return of 3.5%. U.S. small stocks more than doubled the S&P 500, returning 9.1%. Small value stocks underperformed core small stocks. U.S. stocks have had very favorable performance over the previous 5 years, well outpacing the 10-year average. Developed international stock returns were strong in the third quarter. Small stocks outperformed large stocks in the international market. Opposite from the U.S. market, large value and small value stocks outperformed core stocks for the quarter. International stocks have been strong over the previous 1 and 5 year time periods and should continue to offer attractive opportunities for global investors going forward. Emerging markets continue to be a bright spot internationally, posting a dazzling 9% return during the third quarter. Small cap emerging market stocks and frontier market returns were slightly behind but positive. Short-term returns have been phenomenal for emerging markets and modest for frontier markets. We expect growth opportunities to continue for both. Moving on to bonds, most bond asset classes were nearly flat for the quarter with the exception of one. With a return of 1%, TIPS continued their recent streak of strong returns and are now up 6.6% over the previous 1 year period. Short-term and intermediate-term bonds were held down while the 10-year Treasury yield rose by 10 basis points during the third quarter. Alternative assets struggled in the third quarter. Commodities fell 3.9% due to declines in the price for livestock, grains, and energy. Global REITs slowed down in the third quarter and ended nearly flat. Despite a slow third quarter, global REITs have delivered strong returns over their previous 1, 5, and 10-year periods. Managed futures fell this quarter but have offered diversification benefits over the previous 1, 5, and 10-year periods as well. Next, let's look at the asset class returns together. The portfolios on this slide illustrate the hypothetical performance of different global stock bond mixes of indexes. As shown in the bottom left corner, the hypothetical investor with 100% stocks would have fared the best during the past quarter. However, a more diversified portfolio, including allocations to value and small stocks, would have performed even better during the most recent quarter. While larger allocations to stocks have more risk and volatility in the short run, they have higher expected returns over time. The growth of $10,000 chart illustrates this well, as each riskier portfolio has provided a greater return on the initial investment. Since the financial crisis of 2008, the U.S. economy has made lots of progress. While some economic indicators have been volatile and inconsistent, there have been steady improvements along the way. Gross domestic product, or GDP, is a measure of the value of all goods and services produced by a country and serves as a measure of a country's economy. Growth in U.S. real GDP, which removes the effects of inflation, has averaged just over 2% since the recession, which is considered by economists to be a reasonable forward-looking expectation. Aside from a brief period during which inflation turned negative in 2015 when the prices for gasoline and energy tanked, inflation has been creeping along modestly, making progress towards the Fed's target of 2% and now stands at 1.1% year over year. Although the labor market faces challenges related to technological advancements, among others, the unemployment rate has fallen to 5%. Economists refer to this as the full employment rate. Consumer confidence has also reached pre-recession levels. Low interest rates, among other factors, have fueled the improvement in the housing market, which should continue going forward. A key takeaway from this review we want to leave you with is to stay diversified. Stay focused on your long-term goals and don't let short-term performance, good or bad, influence long-term decisions. Although the recovery has been slow and gradual, the U.S. economy has made clear progress since the recession. While some asset classes outperform and others underperform, rebalancing and maintaining your target asset allocation will help you pursue a high probability of success. That wraps up the third quarter of 2016. Thanks for listening.